SCHD is going to outperform the S&P 500 over the next 12 to 18 months, and I will tell you why, and we will go over the pros and cons of SCHD here in this video. So make sure you watch to the end, but let's jump straight to it. SCHD hasn't returned as much as the S&P 500 over the last 5 years, but that's due to its high dividend yield, currently sitting at about 3.43%. This means that for every $1,000 you have invested into SCHD, you will get $34.30 per year in dividends. If you want to calculate how much SCHD you would need to own to make a certain amount in dividends, there's a very easy formula that you can use, and that is taking the amount of dividends that you would like and dividing it by the dividend yield. So here in this example, if you wanted to make $50,000 a year in dividends, if you divide that by 3.43%, you get about $1.45 million worth of SCHD needed. So you might be wondering, why SCHD? Well, if we see the economy contract over the next 12 to 18 months, SCHD is not going to drop as much as the S&P 500, and that is due to its 0.77 beta. If you're not familiar with what a beta is, here's the definition. Beta is a measure of a stock's volatility in relation to the overall stock market. By definition, the market, such as the S&P 500, has a beta of 1, and individual stocks are ranked according to how they deviate from the overall market. The stock that swings more than the overall market has a beta above 1, and a stock that is less has a beta less than 1. If that was difficult for you to understand, here's a really easy example that was really easy for me to visualize. If we compare VOO to SCHD, you'll see that the beta of VOO is 1 and the beta of SCHD is 0.77. For every 1% that VOO goes up, SCHD will only go up 0.77%. So, with a declining market, that can be very beneficial. But let's look at some pros and cons. The first pro is going to be low volatility, which we just talked about with the low beta of 0.77. If the S&P 500 drops by 10%, SCHD is only going to drop by about 7.7%. The next pro is that you will have constant dividend income being deposited back into your account. SCHD does pay a quarterly dividend. And over the last 5 years, the average growth rate of this dividend is 12.33%. Along with having very impressive dividend growth over the last 5 years, SCHD is also very well diversified, holding over 100 different companies. By owning SCHD, you're going to have control over those 100 plus companies that are all very high quality companies. That's why SCHD is one of my favorite ETFs. But with all pros, there are definitely cons. So the first con that we'll talk about is price appreciation. If you were to compare SCHD to VOO, an S&P 500 index, it's not going to compare an overall return, but if you're okay receiving your dividends, then you're going to be just fine. The next con for SCHD is that because it does pay dividend income, you are going to be taxed on that income unless it's invested in a Roth IRA or a different tax deferred vehicle. In about 15 seconds, we'll take a look at the overall chart of where you would fall based on if you're single or if you're married, on where your dividends will be taxed based on income. Before we jump into if you should buy SCHD, I'd really appreciate it if you smash the subscribe button. It really helps out the channel and hopefully pushes this video to someone so that way they take investing a little bit more seriously. So, should you be buying SCHD? And my honest answer is it depends. If it's a stock that you really like, absolutely. But it really depends on your age and where you are in your investing cycle. If you're younger, you probably don't need the dividend income, but as you get older and closer to retirement, you might need that income to subsidize your living. If you do end up buying it, it's important to note where your tax bracket is. If you make less than $47,000 a year, your dividends, if they're ordinary, will be taxed at 0%, but if you make above 47,000 but less than 518,000, your dividends will be taxed at 15%. If you're like me and decide that SCHD is for you, I would recommend dollar cost averaging. This means that you would be buying a handful of shares here and there as the market goes up and down to keep an average price that's consistent with the market. If you've decided that SCHD is not for you because you don't want to pay taxes on the dividends, that's totally fine. There are other options. If you personally would like more growth, I would recommend investing in something that is an S&P 500 index like VOO. And if you're under the age of 40, I would recommend being at least 75% invested in the market. This is because you have plenty of time to get to retirement, so if the market goes up or down, it's not going to do a tremendous amount. I'm sure that you've heard the saying, the best time to plant a tree was 20 years ago, the second best time is now, and the same thing goes for investing. The best time to start was 20 years ago, and the second best time is now. And here's a great example of that. If for 35 years you invested $300 a month into the S&P 500, getting a return of 9.9% as it has over the last 30 years, you would retire with over $1 million in your account. Now, obviously, the sooner you start investing, the more time your money has to grow, so definitely start investing as soon as possible. So, if you're wondering what my plan is going into more shaky months of the stock market, my plan is to just keep on buying dollar cost average into all my positions and continue to buy quality companies while they do get to a more discounted price. Now, as I am only 25 years old, I have plenty of time for retirement, so I would love to be buying all these quality names at a very severe discount, such as Johnson & Johnson, SCHD, any Vanguard fund such as VOO, Kenvu, Pfizer, or even Realty Income. I know that I have a ton of time to get to retirement, so I will just keep buying these companies as I can, but I would really appreciate it if you smash the subscribe button so you can get me a little bit closer to retirement and support me on my journey. But until then, take care, happy investing.